Welcome to this explainer. Look, if you've ever stared at a financial chart and just felt completely, utterly overwhelmed by all the squiggly lines, the flashing numbers, and the absolute mountain of data, you are in the exact right place. Think of me as your mentor today. And hey, don't worry, there's not going to be a pop quiz on advanced calculus at the end of this. We're basically going to take all that chaotic market noise and completely demystify it using a few really simple mathematical concepts. You absolutely do not need an advanced finance degree to get this. You just need to know how to spot the right signs. Okay, so here's our game plan for today. We're going to cover 1. The math behind the trend. 2. Moving averages and finding direction. 3. The RSI and the battle of overbought versus oversold. And finally, number 4, the golden rule.
All right, let's just dive straight into part 1, the math behind the trend.
So here is the absolutely crucial thing you have to remember right out of the gate. Technical indicators? They are not magic crystals. Honestly, a lot of beginners come in thinking there's some secret, fortune-telling device hidden inside these charts. Spoiler alert, there isn't. A technical indicator is literally just a mathematical tool used to confirm a trend that is already happening. That's the whole shebang. It just takes historical price data, runs a quick formula, and spits out a visual guide to help confirm what your eyes are probably already starting to suspect. Remember, it's math, not magic.
Moving right along to part 2, moving averages and how we use them to find direction.
So a moving average basically acts like a compass. Imagine you're driving down this incredibly bumpy, winding, crazy dirt road. You're just bouncing all over the place, right? Well, that is the daily price action of an asset. It's noisy, it's erratic, it's all over the place. What a moving average does is take all those erratic daily bumps, average them out over a set number of days, and draw a nice, smooth line. Suddenly, instead of getting totally distracted by all the chaotic little bumps, you can clearly see the underlying direction the market is actually traveling. Are we generally driving up the mountain or down into the valley? Your moving average compass tells you.
Now let's compare our tools for a second to see how they work together. Our moving average is our compass, right? It shows us the overall trend direction. But our next tool, the RSI, shows us what we call overbought and oversold conditions. Basically, if the moving average tells us where the car is driving, the RSI measures the condition of the engine under the hood. And understanding that difference is a total game changer for any novice trying to navigate the markets.
Which brings us perfectly to part 3, the RSI, or Relative Strength Index, and the concept of overbought versus oversold.
Think of the RSI like a literal thermometer for that market engine we just talked about. It's measuring if things are running too hot or too cold. When an asset's price shoots up incredibly fast, that engine is revving hard, and the RSI thermometer starts to climb. If it climbs too high, it's literally telling you the price action is running dangerously hot, a condition we call overbought. On the flip side, if the price drops like a rock and everyone is panic selling, the thermometer plummets, showing the market is running way too cold or oversold.
Let's actually look at how this plays out on a chart. Notice those first 2 bars sitting there at 40 and 55? That is a totally normal, healthy temperature for our market engine. The trend is just cruising along nicely. But wow, look at that 3rd bar pushing incredibly high up to an RSI of 85. This is a perfect visual of an extreme overbought state. The momentum has stretched the market like a rubber band as far as it can possibly go without snapping. Historically speaking, when that thermometer hits 85, the market is stretched way too thin and is absolutely begging for a cool down.
Okay, so what's the so what here? Why does this matter to you? Well, by identifying these extreme overbought or oversold conditions using RSI data, you can actually spot potential entry signals. If you see that RSI thermometer pegging at 85 like we just saw, the trend is confirming exhaustion. The current momentum might be getting ready to reverse and drop back down to a normal, healthy temperature. And that exhaustion? That is your signal to pay really close attention, because a prime opportunity to enter the market might be forming right in front of you as the trend changes direction.
All right, before you go rushing off to pull up a million charts, we need to hit part 4, the golden rule.
Listen closely to this one, because it's absolutely crucial. Indicators are tools for confirmation, not the sole reason to trade. This is the ultimate golden rule of technical indicators. They are never, ever your only reason to make a move. Let me just say that one more time with my mentor hat firmly on. Do not buy or sell something just because a math line crossed another math line. These tools exist solely to confirm what your other research, like studying the company, reading the economic news, checking the overall market vibes, is already telling you. Think of indicators as the backup singers, definitely not the lead vocalist.
Look, ignoring this rule leads to literally the biggest traps for novices.
The most common beginner mistakes are using indicators as the sole reason to trade and totally forgetting they're just for confirmation. It is so incredibly tempting to impulsively hit that sell button just because you see a high RSI, or blindly hit buy the second a moving average points up. But you have to avoid the mistake of blindly following a math signal without checking the broader context first. I mean, a stock can stay overbought on an RSI chart for a very, very long time if there's some genuinely spectacular fundamental news driving its price to the moon.
So now that you have your moving average compass to find the overall direction and your RSI thermometer to check the engine's temperature, you are honestly miles ahead of where you started, which leaves us with one final, very important question to ponder. How will you use math to confirm your next move? As you prepare to pull up your very first chart, just remember to look for that smoothed out trend, check for market exhaustion, and whatever you do, always follow the golden rule. Thanks so much for hanging out with me for this explainer today, and hey, happy charting!